All right, it looks like we've got most everyone joined and through the door. So I'm going to go ahead and hand it over to Tim and Dan, and we'll get started.
Thanks, Brooke. Again, Dan Packard here, Tim Anderson, joined by Tim Anderson. Happy to be with you here today. This is, I guess, what I'll call our second installment on the CARES Act and on, I guess, all provisions related to economic stimulus. Today, what we want to address is the PPP loans, the newly released application that provides an application for forgiveness to help business owners convert their loan into a forgivable grant. A lot really to cover here. I'm going to begin by sharing my screen with my slide presentation here. And it looks like, Brooke, I need you to enable my ability to screen share. Can you please do that? Thank you. And while we're pulling this up right now, Tim, why don't you kind of lay out for us a little bit, what's the kind of current environment surrounding PPP loans and individuals perhaps? I mean, how far in do you think most applicants are into this 8-week process?
So again, my perspective is last time we met, people were anxiously applying to get some of the money. Again, we've been operating somewhat in the dark. We knew that there would be a potential forgiveness of this money, but it would be classified a loan. Since then, we have received finally an application that people could file to request forgiveness of this loan. Again, we're still waiting for a lot of things to come through, but I envision a lot of you have received the money, you've begun spending it, but still are wondering, how is this all going to settle out?
Mm-hmm. Certainly. I think from my perspective, this is a very chaotic time as well, where so many people have received PPP funding and have been encouraged to use the funds for eligible purposes. That all being said, there is almost daily new guidance that's coming out from the SBA, from the Treasury Department, that influences how applicants are to use that money. Even now, I believe there's 3 bills that are actively being legislated by Congress right now that further modify this application process. So as we go through this today, I hope most listeners will arrive at the conclusion that the patients really will, fortune will favor the patient, those that wait, and wait for that additional guidance.
Again, that's a key word. I hope all of you remember that coming away from this today, is that don't be in a hurry to file for forgiveness, because there are so many things in the works. And understand that even if it is treated like a loan, you have 6 months before the first payment is due. Absolutely.
As of right now, I think there's about $600 billion between the 2 tranches of legislation that they earmarked for PPP loans. Of that amount, 511 has been consumed at this point, leaving about 138 billion yet to be consumed. So for those individuals that have not applied, or perhaps those that have partnerships that have received new guidance about guaranteed payments and distributions to partners, be aware that the funds are still available and there's still opportunity to still apply if you have not yet done so.
And we'll get into more of that detail later, but they have said that in the event that you received less than your fair share when you originally applied, you are still eligible to go back and enlarge the amount that you're going to get from the PPP. This, unlike the first issuance, has not run out yet.
Correct. Now, as I mentioned, we have a new application, Tim, that the SBA released on May 15th, I believe it was. Great document, actually. I believe it's about 11 pages long. They address a lot of the questions, provide a lot of clarity. Despite the fact that there are still questions, I was actually rather impressed with this first offering of an application. It's pretty concise. What a borrower has to fill out is limited really to about 3 to 4 pages. One being the application, the forgiveness calculation, another being a representations page that they sign about certain representations they make and the information they're providing, and then 2 supporting schedules that help them calculate some FTE restrictions as well as salary reduction restrictions as well. So pretty concise document. I gather that larger employers are probably going to have to supplement this document, and really just your average applicant for forgiveness might be a little startled by how much documentation they have to attach to the document, to the application.
Okay, just so everybody knows, at the time you decide to file for forgiveness on your PPP loan, you're going to submit these several documents, and they have been very concise, and it's pretty straightforward on the forms until you start defining what they're asking for. But you will submit that, and then you're going to be required to submit some backup documentation. I was hoping that as a result of today's meeting, you would start to get an idea in your mind of what you should be doing today and the kind of information you need to be collecting before you apply for forgiveness, and then what you need to hold on to protect you in the event of an audit.
I like that. The application, as you can see on your screen, contains 6 individual provisions. First provision being instructions for the application, summary of the costs that are eligible. We've been pretty well educated on what those are: payroll, utilities, rent, mortgage interest. We'll talk more about that a little bit later. The calculation form as well, which I'm excited to go through. I actually went through the application in its entirety with some kind of dummy information on there as well. So I'm excited to kind of walk you through, Tim, what I did and maybe some of the questions that process created in my mind.
I noticed you put my name on there.
You are.
Hence the dummy.
You're one of my employees. In my ideal world, Tim, I employ you, and it feels good. Representations that you have to make, what it means to be a full-time equivalent, and again, this checklist of documentation, some of which you submit, others that you retain.
Okay.
So good information in there. They've already released additional clarification on this. There's a lot of governing bodies in the realm of accounting that are offering continuing commentary on this, saying to the SBA and to the Treasury Department, we still need clarification. And you really, to the Treasury Department's credit, they are responding to a lot of these, I guess, petitions for additional information. That first one came on Friday, 26-page document. I think you read it in its entirety as well. Really, I think it's just additional clarification on what loan forgiveness is and what representations the borrower and the lenders need to be making. Is that fair to say?
That's right. And I think, to their credit, I think the SBA was handed a half-baked cake by Congress, and they're doing what they can to interpret it, but certainly they don't want to take ownership for too much of this.
That's fair. That's fair. What I'd like to do is go over really what the application defines. Number one, what is the covered period? Is there an alternative period that you could utilize to calculate eligible expenditures? What are eligible expenditures? And what are the things that can reduce the forgivable portion of this loan? So what I'd like to do is start with really what is the covered period. Now, when we say covered period, we are referring to the 8-week period that began with the funding of that loan. So when the money hits your bank account, that was the beginning or day one of your covered period. This is the period where they're going to be evaluating whether or not expenditures that were paid and incurred exhaust the PPP funds. They're going to be using the same period for looking at utilities and rent and mortgage interest as well. So this is the period where you have to demonstrate compliance with the provisions of the PPP forgiveness doctrines. The example here being that I'm showing you here is, if your covered period began on April 20th, the last day of that coverage period would be Sunday, June 14th. So kind of use that same, I guess, rationale and apply it to your own individual circumstances.
Okay. So that's 8 weeks.
8 weeks.
To the day.
Bit of a trick question there, right? It is 8 weeks, certainly. They do also define it as 56 days as well. Let's talk more about that a little bit later as we're looking at payroll. Something unique there. But an 8-week period, really, I think the guidance in my mind, Tim, would be sure that you're on the same page with your lender as to when your coverage period is. I mean, what is the covered period? Because really, you need to establish that understanding not only with yourself, but with your lender as well, because they will be helping you make assertions of forgiveness as well.
Okay.
So good individuals to really establish that.
So how would you know your start date?
Start date should be the date that the funds hit your bank account. So I don't know what your experience was. I had a lot of clients that applied. The lender came back to them and said, there's funds available. There's documents I need you to sign. They signed the documents and the money hits the account. In my mind, Tim, it's the moment that the funds hit the account. Is that consistent
I think
with
you're
you as
right.
well?
I think you're right. Once it's in your hands.
Now, there was a unique thing. You probably read it in the 26 pages too, but there's an alternative, I guess, coverage period that covered period that borrowers could utilize as it relates to payroll if their payroll is biweekly. Do you remember reading that in there? What were some of the provisions that stood out to you on that?
Well, one term you're going to hear throughout the day is that the incurred or paid philosophy. If you focus on that conjunction in the middle, or early on, we were talking about incurred and paid to qualify for your expenses. But with the language that came out last Friday, the Small Business Administration has said, if you happen to have a payroll that straddles, so if beginning on day one, you paid a bill that was outstanding, that's going to count, even though it would have been incurred prior to your start date.
Because it was paid during that 8-week period.
It was paid.
Got it.
And then likewise at the end, if you get to the end and you've built up a bunch of hours in your payroll and you pay it after your 8-week period, but you do it on the normal date, you'll be allowed to claim that as well.
Excellent. So this alternative methodology for an 8-week period as it relates to payroll only, not mortgage, interest, or rent or anything like that, but for payroll, you can elect this alternative methodology. And really, I think someone might be motivated to do that for the reasons you just outlined. If there happened to have been a payment on payroll, or they were fearing that they would not incur sufficient payroll by the end of that 8-week period, they may be motivated to do this alternative method. I'm going to be honest, I'm inclined almost just to say, use the normal covered period. It keeps your life a bit more simple. You know, so really, unless you're motivated materially to do it, probably avoid it. Is that fair to say?
That is. Initially, I was thinking that some clients were going to have to report a short payroll, but luckily they don't have to put themselves in that cash crunch. They can just stay on track. And I think, you know, in discussing the biweekly payroll people, you know, they have the potential of getting 10 weeks worth of payroll in their 8-week period if they just stay on track.
Got it. So question here, what if I don't administer payroll biweekly? Does this apply? Can I do this if I don't administer biweekly payroll?
Certainly.
You think so? So there was one provision there that I saw as it relates to individuals that do monthly or quarterly payroll, that they would not allow them to use the alternative methodology. Did you read something similar to that?
I did, but I was in terms of, you know, if you're going to be paying people and your actual pay date falls outside the 8-week cycle, you will still be allowed to count the hours that were incurred in the 8-week period.
Agree 100%. So you can include all incurred payroll that you had even after the 8-week period. However, if you are not a biweekly payroll filer, you cannot use the methodology.
Okay.
So it's a weird nuance there that they've included there. So Tim, these are just a couple of the forms that you fill out pursuant to that application. I mentioned it's a 4-page form. These are the 2 supporting schedules that will help borrowers apply for forgiveness. You'll notice here there's only really room for a handful of employees and a handful of employees that are compensated over $100,000. I'm thinking supporting schedules are going to be needed for a lot of applicants.
I think you're right. Those of you who want to get a bigger picture of this, if you go to the Cooper Norman website and our blog, we have a link to the actual form that you can fill out, and you can read along or follow along with us if you choose. This second one you'll notice is called the Schedule A worksheet. And I think indeed it was meant to be a worksheet. So I would think that you could create your own electronic version and add as many employees as you want, as long as you follow the format that they've presented.
Absolutely. In fact, when I was filling it out for kind of the dummy data that I had put together, I used a spreadsheet because a lot of these columns require some form of calculation. So utilizing Excel or something like that to reach, you know, the conclusions you need to fill this out would be very helpful.
Okay.
Now, you said paid or incurred, big deal. I think that this is a common trend that people need to pay close attention to as it relates not only to payroll, but the non-payroll costs as well too. They are looking at costs that you paid during that 8-week period or those costs that you incurred during that 8-week period. So to make this as simple as possible, let's talk about what is paid payroll and what is incurred payroll. And what's the difference between the two of them?
Well, on any given day of business, I owe my employees for hours they've put in. They've been incurred, whether I've paid it or not. So at any given time during the 8-week period, you know, and this really only matters at the beginning or the end, whatever you have incurred by the last day, you will be able to count as an expense, a qualified expense.
Excellent. So if my 8-week period ends on kind of straddling a pay period, I'm 5 days into a pay period, I've incurred 5 days worth of payroll. Those employees have earned that money. And even though I will pay their payroll after that 8-week period, that 5 days of payroll can be included in my petition for forgiveness.
That's right.
Okay.
Now, at the end, you won't be able to count the whole pay period. You'll be required to prorate it,
Agreed.
but those won't be missed.
Agreed. So does that go for my mortgage interest and my rent as well? Same mentality, same methodology there?
Yes.
Yeah. So if you're halfway through your mortgage payment, you'd probably take a prorated, days of that month that you had already experienced, I guess, to your 8-week period and include that amount.
That's right. Now, many of our agricultural clients make annual mortgage payments.
So it's probably going to require some calculation on their part to, well, that's a great question, Tim. So if I'm an ag producer and I'm paying my mortgage in December, 5-6 months after the end of the PPP.
I think if you can provide the documentation to show that it's been incurred.
Sufficient. I like that. That's a great example of the power of an incurred expenditure.
Right.
Right. Very good. Okay, so let's start by talking about payroll costs. Okay, we're going to talk about all of the payroll and non-payroll costs that qualify, but payroll costs that have been paid and those that have been incurred during the covered period or the alternative period, if you elected to do an alternative period, are included. So they are considered to be paid upon ACH or upon really distributing, I guess you could say, the checks to your employees as well. It is considered to be paid as of that time. Gosh, is there probably anything individuals need to be sensitive to outside of the fact just maybe forecast out what your payroll expenditures are going to be during this 8-week period, including paid and incurred? Anything else that, at least from an advice standpoint, you tell individuals to be sensitive to?
Certainly. I mean, if there's a reason to pay some bonuses or hazard pay, but hopefully as a result of this presentation today, you might have some tools to forecast where you're going to be and whether it's going to be close. Dan has provided a really good example here in a few minutes as to how punitive these penalties could be and how easily they can be avoided.
Absolutely. A lot of the safe harbors they put in place are alarmingly easy to show adherence to. So payroll costs are the sum of your cash compensation. That's a term of art that they use in the application. That means gross salary, gross wages, your tips, commissions, paid leave, allowances for dismissal or separation pay. So, if you have an individual that's even on severance that you've had to let go, that you're paying severance to, you could also include those amounts as amounts paid to employees during this time frame.
Okay. So would it be safe to say anything that's going to end up on a W-2 would count?
Pretty much anything that's going to show up on a W-2 or on 941, I think, would be a qualified expenditure. We get to add to that, though, amounts paid for health insurance, amounts that we pay for employee retirement plans as well as employer, state, and local taxes. That creates a weird, I guess, nuance that I haven't seen answered yet. I wonder if you have. Workman's comp. Can workman's comp be included in this calculation? Do we know yet?
I don't think so. This is one phrase that has been really misunderstood in the law when it said state and local taxes imposed on the employee's earnings. Now remember, this is supposed to be the employer's labor burden. It's supposed to encapsulate all of the labor burden. So along those lines, I would say yes, workers' comp, because you're legally required to have it. Now, does it rise to the level of a tax as described in the original law? I think that's up for debate.
Sure. I agree. I think I'm inclined to tell individuals to include that amount because I agree it's a state mandated expenditure that they have pursuant to their employment. It feels like a state and local tax despite it not being called as such.
Well, and I think that it's a significant expense, especially for contractors that are paying outrageous amounts for workers' comp.
Absolutely. There's a weird nuance here. If I mentioned just now that employers can include their employer contributions for health insurance and for retirement plan contributions. There's a weird nuance though for self-employed individuals, Schedule C filers, and LLC partnership owners as well, that they are not afforded that same opportunity. They cannot include, employer contribution. Well, I should say it's part of cash compensation. In other words, If I have an LLC, I've paid myself $100,000 throughout the year. Included in that $100,000 is going to be my health insurance that I paid on my own behalf, as well as my retirement plan contributions too. So it's a bit, I guess, more punitive to be self-employed because those amounts count as cash compensation.
Yeah, this was some of the language that came out Friday night. And I think they really gave the shaft to sole proprietors and partners in partnerships, just because, you know, if you're receiving a W-2 from your business, if you're an employee, you can go up to $100,000 in compensation and then pile on that your retirement and health insurance. These other two groups, the sole proprietors and the partnerships, are stuck.
They have to include that in their $100,000 calculation. Example would be, I'm an S Corp, I pay myself a reasonable wage. I have the ability to pay myself $100,000 as cash compensation, and then on top of that, contribute to my retirement and my health insurance. But if I'm self-employed, or a sole proprietor, I should say, or a partner in the partnership, I don't have that additional kicker. I lose out on that. It's included in the 100K. Do you think they're going to address this? I mean, fix it?
It depends on how strong their lobby is.
Well, unfortunately, it's generally going to be small business owners.
I wouldn't see it going through.
That's unfortunate, isn't it? Well,
It is.
unfortunate. Okay, and now I'll say this here as well, that if you applied for a PPP loan, you did not pay W-2 wages to yourself or to your employees as well. If you didn't do those things, but you still received funds, it was by virtue of you were taking distributions as a sole proprietor or guaranteed payments as a partner in a partnership. So you can include those amounts, obviously, in your application for forgiveness. That is your payroll burden that qualifies.
And I'll just throw this out there. This was not common knowledge when the program was introduced. And a lot of applications missed this, that your potential PPP loan could have been limited because your compensation as a partner was never considered.
100%. I can't tell you how many lenders, I'm not blaming the lenders, I'm just blaming the fact we didn't know enough, right? But how many lenders said we cannot include guaranteed payments in this calculation? 10 days ago, guidance came out that said the exact opposite, that if you applied and you did not include guaranteed payments that you paid, reapply and ask for those funds because they can be included.
Good advice.
Yeah. Okay, so payroll costs, you've mentioned bonuses and hazard pay to help you consume those amounts, commission payments to furloughed employees as well. There's a lot that we can include in that. Any one individual, though, cannot be paid more than $100,000 of cash compensation. Again, cash compensation being the sum of, bullet point 1 on this slide, cannot receive more than $100,000 of cash compensation. You do the math, that's $15,385 during this period. The application makes specific mention of that figure. $15,385 is the limit per employee that you can claim as qualified payroll expenditures pursuant to forgiveness here.
Okay, so I think it's easier to think of in terms of, my employees are going to be receiving different amounts every week. But if you can annualize what they're getting paid at any given payroll, what does that equate to on an annual basis? Mm-hmm. I think that'll help people get through the calculations that we're going to talk about.
I agree. Now, so that gets us through payroll. We feel comfortable there, I think. Next qualified expenditure is mortgage. We call these non-payroll expenditures within the application. So mortgage being the first one. They use a few terms here that I'll admit, Tim, I don't love. I don't love the fact that they use the word mortgage. I don't love the fact that they use that word in connection with the term personal property as well. When I hear the word mortgage, I think about a building. I think about real estate. I don't think about personal property. And personal property is a term of art within tax law that is in reference to equipment and other business assets that are not real estate, right? So I don't know, did you feel a bit confused maybe by that verbiage as well?
I really do, because any one of us pays a myriad of different types of interest. Now, deciphering between each one of those as to whether it's going to be a qualified expense for loan forgiveness, really becomes a game.
Absolutely. I think we have to, you said it so artfully earlier, where you have, legislators, the Senate and the House that craft law that the Treasury Department and the SBA is now trying their best to interpret, right? I think what we need to do is put on kind of those interpreters and try to understand what the true intent here was. They make mention of mortgage obligations that existed before February 15th. So in my mind, when you say mortgage, I think about an amortization schedule. I think that I've acquired something that I have to make consistent payments on. And given the fact that they've said real or personal property, if I'm a business owner, I'm pretty much saying if it's something I can touch, it's likely something that will qualify as mortgage interest that can be used for forgiveness.
As a term loan, a loan that has a term.
There you go.
One thing what keeps going through my mind is, say you have an operating line. If you have a farm, if you have a construction business, oftentimes that is secured by something on your asset, on your balance sheet.
However, the fact that you did not have an existing, perhaps ongoing arrangement as of February 15th that the line renews probably challenges that the inclusion of a line of credit.
I'm really curious on this one to see where it goes. Because part of me says you could look at it and say the intent of Congress was to keep business going. And so having access to operating capital is vital to that.
Certainly.
But it's not going to meet the definition, I don't believe, of what they've said here.
So I think you and I could both agree that as of right now, mortgage interest payments constitute any loan, existing loan arrangement, term loan arrangement that you have that existed prior to February 15th, 2020 for things like business equipment, business assets, and real estate.
So if you have equipment loans, certainly things that are being termed out.
Got it. Now, what I like about the guidance is that it's pretty much any obligation that you had, even prior to the 8-week period as well, too. So if you happen to be delinquent on payments, you can get caught up with these PPP funds as well. They do state, though, that you cannot make advance payments on your mortgage. So they're fine getting you caught up. You cannot use these funds to make advances on mortgage payments.
Again, incurred.
Incurred. There you go. That's the magic word. Is it paid or is it incurred? And incurred effectively means that I've occupied the space and therefore have an obligation to pay.
Good.
Okay, I like that. Rent or lease, okay? So business rent or lease payments on real or personal property, again, so again, equipment or real estate that we have, where lease agreements were in place prior to February 15th of 2020. So I'm thinking for ag producers, I'm thinking about combines, trucks, tractors, any lease arrangement that they presently have with an equipment broker. I'm thinking about rent payments that are paid on all buildings that individuals occupy. I'm also mindful of self-rental arrangements that individuals have with themselves, that perhaps they have an LLC that owns the building that they practice out of, and a rent is paid over from their operator.
Yeah, for a long time, it's been good asset protection to have your real estate in a separate legal entity that your operating entity would pay rent to. So certainly, the important thing is that there is a lease in place. And this will be one of the required documents that is provided when the application is submitted for forgiveness.
So applicants need to have a lease agreement that's put in place. Even for self-rentals, they need to have one of those ready to provide to the lender when they submit their application.
So make sure as you're gathering documents, this is part of your packet that you can provide.
I like that. Final one, Tim, is utilities. I reread this portion of the application probably 3 or 4 times, trying to really get into what is a utility expenditure, okay? So you'll have to forgive me. I'm gonna read from the slide on this one because there's something important here to, I think, pull away from it. It is for business payments for the service, for a service for the distribution of electricity, gas, water, transportation, telephone, or internet access for which the service began before February 15, 2020. Now, there are easy ones here, right? Our natural gas, our electric bill, our telephone service that we have, internet, they make those easy. The word transportation, I think, creates in a lot of people's mind, is my fuel, something that I can include as a utility. So there are easy ones to understand, ones that I have to say, what is a transportation arrangement that existed prior to February 15th? I mean, because they make it sound like a contract, right? What are your thoughts there? I mean, what?
I really have no idea. I mean, my mind goes a lot of different places. If I had a contract in place for a shipper to be moving my product or my equipment on an ongoing basis, maybe that would qualify. If I had a contract with a fuel broker to be providing me with fuel on an ongoing basis, this one is really hard.
It's sticky. I think for right now, what we know right now. Now, I mentioned a lot of the governing bodies within our accounting realm that are petitioning for additional clarification. This is one that they focused on. They said, describe to us what transportation is. I think by next week, we're going to have an answer to this. But as of right now, I think we need to understand it for what it is. It's those contract, more fixed in nature utility costs that a business incurs. I agree with you. I mean, you're going to have contracts for fuel, contracts for shipping as well. But on the flip side, you'd have to also say, this feels kind of variable in nature, that I really only incur those costs as I consume those services.
What would you say about custodial services, janitorial services?
Right. Right. Great questions. I think what we need to take away, or what a borrower should take away at this point, electricity, gas, water, telephone, and internet access are no-brainers at this point. And if you're confused about transportation, then join the club, right? Because we're all there right now. And even, the smartest individuals within this realm are asking that question.
They have said that cell phones qualify as telephones.
I agree. Landlines only, that'd be weird, wouldn't it? Okay, now, so we've talked about eligible expenditures. We now need to talk about the things that can reduce the forgivable portion. You're going to see here in a moment the example I gave. I pretended that I was a business owner that had 5 employees, that I qualified for $100,000 of forgiveness, and then pretty much ran myself through a torture test of trying to fail every single test, okay? The average FTE is a full-time equivalent, and it's the first test that you have to pass as it relates to forgiveness. They can reduce the forgivable portion of your loan based on whether or not the employees that you had or the full-time accounts had during your reference period or a period prior to the disaster, your loan period, compared to your covered period. If there's a material reduction, they will reduce the forgivable portion of your loan.
So if we back up, way to the beginning, the SBA gives you the loan. They said, we can forgive this if you spend the money how we tell you, 75% on payroll, 25% on the qualified non-payroll expenses. Spend it accordingly. However, we can reduce the amount that you're potentially going to be forgiven if you have reduced your labor force, your workforce in the middle of all this, or if you have reduced people's pay. We're going to ding you for that. So now we're jumping into these tests and we'll see how we can beat them.
Yep, that's right. Okay, so this first one, I bolded the term here, reference period. This is the period that the SBA is going to be comparing your full-time equivalent counts during the covered period or during your loan period. They're going to be comparing that number to your reference period. Now, the application states that your reference period is one of 3 date ranges, okay? The first one being February 15th, 2019 to June 30th, 2019. So that's what, last year, effectively, about this time. January 1, 2020 to February 29, 2020, Q1 of this year, okay? Or if you are a seasonal employer, you have the ability to use any 12 consecutive weeks between May 1 and September 15th of last year. So to beat the test, right, ideally a business owner would want to find a reference period that had the fewest number of FTEs within it, right? You want to find a reference period that says, okay, at this point, one of these 3 areas, I had the fewest number of full-time equivalents.
Okay, so if I understand you correctly, we're going to start off with, we can pick one of 3 dates that we're going to measure against. So they've given us 3 possible dates that we can compare our present situation against to see if we've reduced our workforce.
Correct. And those 3 ranges are on page 5 of the application. Okay, great. Now, to calculate what a full-time equivalent is, they are asking you to evaluate employees on a 40-hour work week. A lot of the language leading up to this was 30 hours, 32 hours. It is a 40-hour work week, okay? So if you have an individual that worked on average during our covered period, our status quo, time frame, more than 40 hours a week, they're going to be assigned a 1, okay? They are 1 full-time equivalent. Individuals that work less than that will receive, some fraction of that number. You work 32 hours, you're a 0.8, okay?
Okay.
So there's going to be amounts that they will go ahead and, assign to each individual, rounded to the nearest tenth. There's also a simplified method that you can use that just says, listen, if they work over 40 hours, they're a 1, and if they work under 40 hours, they're a 0.5. There's going to probably be limited circumstances where that's a good idea,
Okay.
Really, if you have a huge population of employees that do not work a lot at all, maybe less than 10 hours a week, that might work. That might be a good idea.
Okay.
But again, alternative methods probably going to complicate things.
So thought that just went through my mind is, okay, if I have 3 possible dates in the past, I can set as my baseline. Which one do I pick?
Pick the one that has the fewest number of full-time equivalents, because again, you're trying to prove to the SBA that you have not reduced your workforce. And right now, if you have fewer full-time equivalents, then find a comparative period that looks a lot like right now.
Okay.
Now, I ran through what a full-time equivalent calculation would look like for purposes of this application. You'll see I have you, myself, Rolyn, Tyrell, and Terry, all friends that I have here at the firm, okay? And I averaged their hours during that 8-week period. You'll see, Tim, that you average more than 1, but according to the application, I need to assign you a 1.
Okay.
I assign myself a 0.8 because I am less than 40 hours per week. Rolyn is a 1, Tyrell is a 0.7, and Terry's a 0.9. So summing those all together during my covered period, right now, I have 4.4 full-time equivalents.
Okay. Is this the same method you would use in one of those 3 alternate dates you have to set the date?
Identical. You use this exact same methodology.
So you couldn't switch it up?
Can't switch it up. You have to use the same methodology.
Okay.
So if I used this methodology, not the simplified method, I used this methodology, I have to use this methodology again for the reference period calculation.
Okay.
Okay. I populated Schedule A, one of the supporting schedules. I think it's on page 9. The supporting schedule here with this information. You'll notice that Table 1 has all employees that make less than $100,000 annualized. You're going to see why here in just a moment. And Tim, because you make more than $100,000 in my example, you are on your own separate table with the default $15,385. The application says I cannot say that you made more than that for purposes of forgiveness. Now listen, during this period, Tim, you could have made more than that. You really could. You could have made $18,000, $20,000, $25,000. They don't care. They're going to say that you are capped at the $15,385 for purposes of forgiveness.
And really, they don't care about anybody that makes more than that.
In a very general sense, that's a true statement.
Okay.
Not a lot of protections out there for people that make more than that in this realm. Okay. Now there are certain exceptions. Okay. Now you'll see that I've included in these individuals 5 employees. You can exclude from the calculation both the reference period and your covered period. You can exclude certain employees from that calculation if that individual rejected your offer to be rehired. Now, this sounds crazy, but it's happening very frequently. The unemployment office has made it very lucrative for individuals to remain unemployed. Between the federal and state incentives, it's hard for employers to bring people back. If an employer made a good faith written offer, it's not a verbal, you have to make a written offer to rehire an individual and they turn you down, you have the ability to remove them from your calculation, which is a great, I guess, benefit, right?
And that's not awkward.
That's not awkward, right? Now, also individuals that were fired for cause, also individuals that voluntarily resigned, or those that requested to receive a reduction of their hours. So if you have these 3 individuals that said, reduce my hours, I'm perhaps concerned about COVID, reduce my hours, I'm leaving, I'm resigning, or you had to fire them for cause, I see probably great need for documentation here, Tim.
Yes.
That's probably what's going off in your mind here too. But if any of these 4 circumstances are true, you can exclude them from this calculation, which is of great benefit, really.
So when we establish our base period, do we factor it in on the beginning or the end?
Repeat the question there.
So this is, as I've been reading the law, this becomes a kind of a confusing area for me. We can establish our base, picking one of the 3 dates early.
Correct.
We're going to compare that to our current status. Do we adjust the current status by those people who left that we don't have to account for?
You remove them from both. They are removed from your reference period and your covered period.
Okay.
They are not part of the calculation at all.
Okay.
So, now, the document that was released on Friday turned a lot of employers into tattletales, unfortunately, because they are required, if they were turned down, if you offered employment back to an employee that you previously had, that you were offering to rehire them and they turned you down, you were required to tell the state unemployment office within 30 days of their rejection.
And that's not awkward either.
That's not awkward either. Yeah. So Tim, I think there's a lot of employers that perhaps have encountered that may not have told the state unemployment office. They need to do so now. I do not know how they do that. I don't know if it's written, if they're supposed to call. I don't know how, but the document says that they have to do that. So anyway, something to bear in mind. I think they're trying to mobilize the workforce again, Tim. I think that's what's really going on here.
Well, it's been kind of lucrative for a lot of people.
Yeah, absolutely. Now, we use the word safe harbor. This is actually a term that's used often in tax law to describe things that taxpayers can do to avail themselves from scrutiny. If they meet the rules of a safe harbor, the IRS, the Treasury Department, the SBA is not going to give them trouble. They're going to say you played by the rules, okay? There is a safe harbor here as it relates to the full-time equivalent calculation, okay? And what you have to do is say you have to meet, pay attention to the second bullet point here. The borrower has to demonstrate two things. One, that the borrower's full-time equivalents went down from February 15th to April 26th, which most everyone did. Most people had to lay people off. So most people are going to meet that first parameter. The second parameter is that they have to demonstrate that they restored their full-time equivalent employees by not later than June 30th, okay? All they have to do is show to the SBA that they have hired back and restored full-time equivalents as of June 30th.
So in this instance, as we're talking about safe harbor, we totally forget about that spreadsheet you just put up for averaging people's pay. We just say, okay, as of June 30th, the people that are working on June 30th are expected to be working as many hours as they did in the measurement period.
Sure, they're contracted to do so. Tim, what we don't know is really the documentation we provide to SBA to assert this. Reasonably, we'd probably say employment contracts. Have you employed sufficient people? Again, your comparison date is February 15th. So they're going to look at February 15th and compare it to June 30th and say, are your full-time equivalents the same or greater than February 15th?
And I would say exactly, we need to get documents in their employee file saying maybe a memorandum of understanding. This has been a temporary slowdown, effective immediately. You'll
Absolutely.
be back to working the hours you were before.
It
It was
also-
expected to.
Absolutely, and it brings to light, Tim, something else, that June 30th is the date that they demonstrate that. Well, so many people are going to have their application, their 8-week period is going to be up and done prior to June 30th. But if they want to apply for, or I guess, qualify under this safe harbor provision, they're not going to be sending in applications until probably well into July, right? I mean, you have to wait until June 30th to demonstrate that you've done that.
Gives me a chance to hire all my kids.
Tim is the most popular CPA in the entire Pacific Northwest for a lot of reasons. No, it's a great point. I mean, that you have some time to establish a workforce. Be creative if you need to, but you have time to establish your workforce and demonstrate full-time equivalents by June 30th. So even though your 8 weeks are up, it's still not too late to do things that can influence the forgiveness of that loan. Okay, so that was provision number one. Full-time equivalents can reduce the forgiveness of that loan, okay? Number two is a salary reduction. So if there's any one individual that you have right now that you've materially undercompensated compared to a previous period, then you can also be subject to a reduction in your forgivable loan, okay? So we're gonna go, this is probably best explained with an example, okay? The law states that you cannot reduce someone's payroll by more than 25% on an annualized basis without being penalized. If you do more than 25%, expect a reduction of your loan, okay? So what we're gonna look at real quick is, it's a lot of numbers here, I apologize, but we're gonna go through this right now. And Tim, the first thing you're gonna note is that you are no longer an employee of mine in this analysis. It's because you make more than $100,000. The IRS does not care if you are materially undercompensated if you make over $100,000, okay? So you are not included in that, which is why the application that I showed right here has table 1 listing only those that made less than $100,000, because it only applies to them. Note this final box 3 column right here. That's where we put in the reduction amount.
Okay.
You do not have one. So let's go back to our calculation here. I put in just some sample numbers here. Line 1 is just compensation during the 8-week period, how much I paid each one of these individuals. And I annualize that or divide it by 8 divided by 52, which is 8 weeks out of 52 weeks, okay? To come up with what each one of these individuals made on an annualized basis, okay?
So absent anything else, you would be expected to earn 65,000 for the year.
There you go. Yep, absent any change really to my compensation, my annualized wage is $65,000. They then ask you to compare that to the compensation that was paid from January 1 through March 31, okay? So you look at 3-month period and say, okay, how much was that individual paid just prior to all of this happening? You report that as well and annualize it again. That's going to be, your 12 weeks divided by 52. I'm annualizing that again. And you'll note that I've done a bit of a calculation here saying, okay, Dan's compensation changed by only 4%. Okay, I paid myself less, about $3,000 less than I did during that January to March timeframe. Roll-ins changed by about 2.7.
Well, and because yours is less than 25%, there's no penalty.
There's no penalty. The analysis at that point is done.
Okay.
If I have not changed more than 25%, we're done. Okay.
And this is an individual by individual. Okay.
It is. Now, Tyrell is where we get sticky. Okay. He is someone that has been materially undercompensated to the tune of about 32%. Annualized from January to March was $96,000, but annualized during my covered period was only $65,000. Okay. So he's been materially undercompensated. Okay.
So even though he worked fewer hours, it doesn't matter.
He made less money.
Even though we're paying him the same hourly rate,
He made less money.
we're just looking at total dollars.
They want to know what he was paid. They don't care about the hours. They want to know what he was paid.
Okay.
Okay. And which is why you're going to see here in a moment why these forgivable loan amounts, these penalties, I'll call them, they're not additive. They don't add on top of one another. They just take the biggest penalty and deduct that from you.
Naturally.
So, naturally. Okay, Terry's at 8.4% reduction. Again, we're fine. We're not concerned about that because it's not a 25% change in comp. But because Tyrell is of that, in that circumstance of having a 32% reduction, we need to go to step 2 with him. Now, these next questions are another safe harbor. This is another one of these safe harbors that says, okay, his annual salary as of February 15th, I'm going to say was $96,000. But his annual salary, his average annual salary from February 15th to April 26th was $65,000. This is the kicker. They ask you, what was his annual salary as of June 30th? So that exact date, what was his his annual salary? Okay. If you can say to that question, we bumped him back up to 96. He was working normal hours again. His rate was restored to where it was. He's at 96 again. Analysis is done.
So there again, more documentation in the employee file may save you at the end.
And lends a lot of power to the June 30th date. June 30 matters because if you can restore their hours and you can restore their pay by June 30th, or at least demonstrate that you're going to do that, then you're good. Okay. Now, again, I told you I tripped every alarm that I could on this. Okay. But I made the assertion here that as of June 30th, I had not restored his wage. Okay. Here is one thing that the application has to have fixed. Okay. The law itself says the term annual salary as of June 30th. The application says average annual salary, but does not give a date range. I bet you money by next week that word average goes away because it confuses this application.
Yeah, what are you averaging?
What are you averaging? A single day? A single day, because again, it doesn't give you a date range. Okay. So if you can demonstrate that you have restored pay by June 30th, you can clear this test. Okay. So what I do, showing that I did not meet that safe harbor, I have to go to step 3 with Tyrell and state, okay, I now have to multiply line 6, which is the compensation that he made during the January to March timeframe when things were normal. I multiply that by 75% and then show what the change was between what he was paid in the covered period and that amount. So it's a $7,000 ding to me, given that I've undercompensated Tyrell.
Okay.
Okay. Now we're going to go down the road and you're going to eventually see that there are times you could even end up paying the Treasury Department, even more money than what you could have just paid the employee had you just fully compensated them. So these are designed to really incentivize and help employees. Okay, so with that new information, Tim, I've added that to box 3 column, this column right here. That's 7198, and I'm now ready to go on and fill out the application. Okay. So I began by filling out Schedule A. $45,000 is the compensation from all these individuals right here, all the less than 100K individuals. They constitute 3.4 full-time equivalents, and I have $7,100 of impairment because of Tyrell, because I undercompensated him. I have your compensation and the fact that you're a full-time equivalent, and what I paid for employee health insurance, what I paid for retirement, and what I paid for state and local taxes as well, bringing the grand total to $64,485. Okay, so that's a number that will go onto page 1 of my application. Furthermore,
So this
go
is
ahead.
your total labor burden you're going to report to the IRS, to the SBA.
That's right. And at the very bottom of this too is my full-time calculation. Everyone saw how we calculated the 4.4. In my example here, I have told the Treasury Department that I have not restored my full-time equivalents, and I had more full-time people during one of the 3 reference periods that I picked. Okay,
So that's as low as you could come up with.
That's as low as I could come up with, was 5.5. And I was unwilling to restore my workforce by June 30th.
Okay.
Okay, so that's a 0.8 quotient that they show there. Okay. All right, so this is where the rubber hits the road. Okay. I had a $100,000 PPP loan. I was also advanced in my example, $5,000 of EDL money, that economic injury disaster loan money. And I now populate the form with all of the information that I had filled out in the previous supporting schedules. $64,000 of payroll. I put in $10,000 of mortgage interest, just, you know, for our purposes here. Rent of $7,500 and utilities of $5,000. I show the amount right here that I have to reduce this by the amount of Tyrell's undercompensation. Okay, which brings us to $79,787. That number is now multiplied by my quotient of 0.8, okay, because I did not have enough full-time equivalents. So that entire number down here, 79,787, okay, multiplied by 0.8 is 63,830. My PPP loan was 100,000. And if I take my payroll costs that I had, the 64,000, and divide it by 0.75, that's 85,000, okay? So the long and short of what you're looking at here, Tim, is 3 different numbers that will be my forgivable amount. And I have to take the most punitive of those numbers, okay? Takeaway here being that make sure that payroll is 75% of the exhausted funds. Make sure that you restore your full-time equivalents. Consume all of the funds, because in my example, I did not consume all of the funds. Consume the entirety of the funds that you have available for the PPP loan, and be sure that you restore everyone's compensation to where it was as of February 15th by June 30th.
So we're paying $37,000 back of our 100,000. What could we have done to fix that?
In my mind, I should have used all the way to June 30th to restore my workforce. I should have made the statement, and I should have restored Tyrell's compensation to where it was as of February 15th. I also should have made sure that payroll was 75% of what I had, because in my example here, it's something like 65%. If it's 75%, Tim, in the example that we have here, I should have used bonuses, or I should have used hazard pay. I should have done something like that to meet that threshold.
Okay, all easy fixes.
Easy fixes.
Because I think most of us would probably be happy to say, I would rather give this money to my employee than to give it back to the government.
And that may even include compensating, again, family members for single owner S corporations. It could include things like that as well.
Okay.
So anything else come to your mind that we should probably be sensitive to?
I know for a fact that sole proprietors don't have to jump through these hoops, because their entire amount is based on their net employment earnings on their Schedule C, or their net self-employment income on their K-1 they receive from their partnership.
Right.
That's it.
Right.
No testing, no base period.
Just if they can demonstrate they actually distribute those funds to themselves, and they're going to be fine.
Right.
And they don't make more than $100,000.
Exactly.
So that's the sticky part, right? Okay, so documentation, 2 types. The documentation you send to the bank and the kind that you don't send to the bank, right? For documentation, the application lays out the fact that we need to have, and maybe while I'm going through this, Tim, will you go ahead and see if we have any questions that we can answer to? We're nearing the end of our hour here. The documentation that the bank's going to be requesting as it relates to payroll is going to be things like bank statements and payroll provider reports as well. A lot of people had separate accounts that were set up for their PPP funds, and that's fine. But bear in mind, really any bank statement that shows that the money is being used for payroll is sufficient. You do not need to demonstrate integrity in using only one account or your PPP loan account. Just demonstrate that the funds were used for payroll. Provide the 941 during that period as well as canceled checks. I'm thinking pay stubs, as well as information from employer contributions for health insurance contributions and retirement plan contributions too. So payroll, there's probably three things. It's going to be bank statements, in addition to your payroll summary, your tax forms, pay stubs, and then also your health insurance and retirement plan amounts from your providers. So a lot of invoices, a lot of statements that need to be attached to that. I'll point out that, again, bank statements for that period are not going to be available until the following month, July. So for those that are super anxious about applying for forgiveness, pump the brakes.
Your quarterly payroll statements.
Quarterly payrolls aren't going to be available for another month as well too. So again, pump the brakes.
Yeah, I would say do it right the first time.
Absolutely. Now, Tim, you were telling me a little while ago, I mean, worst case scenario, this thing's alone. When's the first payment even due on this?
So it's 6 months from the time it funds.
So really, people have a lot of time here to demonstrate to their lender and to the SBA that this is a forgivable amount.
And I will also point out that the statute of limitations for this, for the SBA to review it, is at a minimum 6 years and could extend as far as 10 years. So it's important to do it right, just to make sure that, I mean, when it is reviewed, it just goes through seamlessly.
Agreed. Documentation also has to be provided as it relates to your full-time equivalents. So you need to show hours that were worked during the comparison periods that we have there, your reference periods, as well as the covered periods. Tax form should also help with that calculation as well. And finally, for non-payroll, we're looking for amortization schedules, canceled checks, account statements, so demonstrating that the loan was paid down on or a rent was paid as well. Lease agreements, this is a big one. Again, even for self-imposed leases or rents, you need to have a lease agreement that you can provide to the lender. And finally, any invoices for utility payments that you have as well.
That's pretty extensive list of documentation.
So far, my stack's about this high so far, right? And I still have a couple other things that we need to chat about too, that we'll probably need to attach, okay? So checklist, identify really just showing almost a tracing of these funds between the bank statement and all invoices. The application probably does not need to be submitted until probably July, when this documentation is actually available that you can provide. There is a whole list, Tim, of other documentation on the application that I wish I had time to review, but I would direct our readers to go to page 10 of the application under the section documents that each borrower must maintain, but is not required to submit. You mentioned a 6-year statute period. This is documentation people need to keep in a file during this period to ensure that if ever they are audited by SBA, they can prevail.
So hopefully one takeaway you're getting is, things that I can do today that I can do now is I can take a look at the list and make sure that I have everything that I can provide to the bank and put in my audit file.
Absolutely. Absolutely. And outside of that, I have a final bullet point here, just representations from the borrower. Bear in mind that it's not your CPA, your lender, the SBA's job to verify the integrity of this. The borrower is required to sign this application, asserting that all information that's been provided is correct and is true. So again, obviously solicit the help of your CPA in helping prepare this documentation and your lender, but just bear in mind that you're representing that you understand this and that you are providing accurate documentation.
And I honestly believe that anybody should be able to get forgiveness if they're thoughtful enough and they're spending the money how it was intended.
Absolutely. Before we go on to just a couple of things that are unknown, any questions that stood out to you? We'll do our best to address other questions via a blog post or email.
Just one question I wanted, I'll go through a couple of these. One was if you've got a workout with your lender and your interest has been deferred with your lender and you go ahead and pay it, is that still a qualified expense?
What do you think?
I think you still have the obligation. You have incurred interest. Even though you're not legally bound to pay it in a specific time, you've got a contract in place as of February 15th. The clock's still ticking.
So really, I think that comes down just to documentation. If you can demonstrate an amortization schedule and a payment schedule that supports that you both paid and incurred, well, that you paid it and that it was an amount that was in fact previously incurred, I agree. I think you're in a good spot there.
Okay. There's a question. What happens during the testing of your employees if they get paid more during the measurement period than they did for the base period?
So my covered period is higher than my reference period.
Yes.
A lot of different words here. Then you're good.
Okay.
You did a great job. No penalty, gold star.
A similar question, what if we now have more employees than in the covered period? Again,
You're satisfying it.
you're safe. Question about seasonal employees. In the case of seasonal employers, either of the preceding periods or a consecutive 12-week period between May 1st, 2019 and September 15th, 2019, the SBA has not defined seasonal employers, but the banks are required to sign off on qualified business during this period. Do you know exactly what the definition is of a seasonal employer for purposes of the SBA?
They've offered qualitative guidance, not quantitative guidance. So the qualitative guidance is along the lines of just demonstrating a mercurial nature to your revenue, that it's erratic, right? That there's a cycle to your revenue that you can demonstrate or at least illustrate, right? Is there a quantitative threshold? No, there is not one. But there are certain industries that I think very easily can make that assertion. You know, ag producers being some of them, entertainment being some of them as well. There are those that'll be very easy to do it. Perhaps medical professionals are going to struggle with that, showing a seasonality or demonstrating that they're seasonal employee.
That's a good point. That's a good point. Isn't there a specific window you have to file within to make sure you qualify for forgiveness?
Go ahead.
We were talking about this morning.
Mm-hmm.
You know, until you apply for forgiveness, you are holding on to a loan. You have a loan from the Small Business Administration. You have the opportunity to request forgiveness up until this loan is paid off, which is a long time. To avoid incurring any interest charges, you're better off to request it before a 6-month payment is due, your first payment in 6 months. But I mean, there is no immediate action you have to take as it sits today.
Well, and I think people also need to bear in mind that even the application itself that requests bank statements, requests 941s, requests documentation that simply is not available right now. Furthermore, all of the safe harbors are based on the June 30th timeframe. There's not a single person that can even apply for forgiveness right now and do so accurately. So I think in most people's minds, they need to be saying, yes, I want to apply for forgiveness as soon as possible, get this monkey off my back. But just bear in mind, you do not have the resources to do that right now, and probably will not have those resources until July.
To get a complete application in.
That's correct.
But hopefully after today, you have some tools to do some forecasting to see if you're going to have any trouble areas.
Absolutely.
And, you know, here again, we're happy to help anybody that may be wondering, you know, where the hazards are in your particular case.
Agreed.
Let's go ahead.
Okay, well, I'm gonna wrap up with a few things that we still don't know. Number one, this can still change. Everything that we've said today, Tim, can change tomorrow. And if the past is any indication of our future, it will change, because what we're discussing right now is not what we had 3 months ago. Okay, so please take this. This is based on what we know right now, and as we learn more, we will inform our clients of those changes. Okay. Some of the biggest things that are being legislated right now, there's, I believe, 3 bills right now being legislated by Congress that are targeted on a couple things. One is extending the 8-week period, the covered period, doubling it out to 16. Is it 16 weeks that they want?
One is 16 and one is 24.
Yeah. So I mean, really, they're really looking to widen that out, which means application for forgiveness would be 3 months from now. It'd be nearly 6 months from now. Okay. Beyond that as well, they're also looking to remove the 75% requirement on payroll, allowing individuals to use this money more for non-payroll costs as well.
I don't see that happening.
Why is that?
Just because so much emphasis has been put on keeping workers working. And, you know, the 75% requirement really obligates you to protecting your workforce, as it were.
I agree. I don't see that catching fire either, but by that same token, this is really, I'm thinking about the small business owner as well too, that is, I guess, penalized by the fact that they cannot use this money for other expenditures that they have outside of their own payroll. You know, so it's a tough balance for them to try to strike. I think they're still gathering a lot of sponsors right now for some of these bills as well. They were hoping to have answers to this by this week. My gut tells me early next week we're going to hear something, but I don't know, time will tell.
Very soon. I mean, gaining a lot of traction, and there's support from both sides of the aisle.
Agreed. Okay, Tim, I think with that, we're going to conclude. Brooke, we will turn the time back over to you. Again, appreciate the opportunity to speak to everyone. This broadcast will be available on our YouTube page. The link will be available on our blog. We will also include our slides as a PDF for individuals that want to review those as well. And also any listener that would like access to the spreadsheet that I use to calculate the SBA application, I'd ask that they just email me. Brooke will send you my email address and I would be happy to forward that to you.
And your Venmo contact.
And my Venmo and my bank information and all that good stuff. So, all right, with that, Brooke, we'll turn the time back to you. Thank you.
Great. Thank you, Dan and Tim, for putting all of that information together. And thank you, everyone who registered and attended the webinar today. We really appreciate it. And with that, everyone have a very nice evening. All right.